Welcome to another market update from Sentara Capital. I'm Will Allen. As we move into the second half of 2014, stocks have been a mixed bag so far this year. The S&P 500 has had a strong run with a gain of almost 6% through Thursday, July 17th. However, not all indices have fared so well. The Dow Jones Industrial Average is only up 2.5%. International stocks, as represented by the MSCI EAFE index, are up less than 1%, and the Russell 2000, which measures the performance of small cap stocks, is down over 2% year to date. Now, the fact that the S&P 500, which is the most widely followed stock index, is up almost 6% this year is impressive on the heels of last year's 32% gain. But what has been the most interesting story has been the performance of the bond market. Now, last year, bonds lost money as investors sold bonds and bought stocks. This chart shows the increase in yield on the 10-year U.S. Treasury bond from 2013. Now, as a reminder, yields, or interest rates, go up when prices fall. And last year, investors had an appetite for risk, selling bonds and buying stocks. Now, as we came into 2014, the general consensus among the top bond money managers and economists were for bond yields to continue rising. But as you can see, looking at the 10-year U.S. Treasury yield, that has not happened. Investors have bought bonds, driving yields from 3% to under 2.5% now. One of the primary reasons many investors buy U.S. Treasuries is for safety. So when buying interest unexpectedly rises, as it has this year, it's definitely worth paying attention to. Only time will tell if the increased demands for bonds is a harbinger of trouble ahead for the stock market. Now, shifting over to economic data, we have had the best 5-month stretch for job growth since the economic recovery began. 5 straight months of over 200,000 jobs added here in the U.S. Now, we still have a long ways to go to achieve a healthy employment picture, but this is a step in the right direction. Now, last month we addressed GDP growth in our video update, and just this month, JP Morgan has come out with their updated 2014 GDP forecast. They have slashed their estimates in half, now projecting 1.4% growth, which is down from their original forecast of 2.8%. Now, as we said in our video last month, this continues a 4-year trend where U.S. GDP growth has fallen short of initial projections. As we close out, it's worth noting that all eyes are on corporate earnings reports as we are in the heart of second quarter earnings season. Stronger than expected revenue and earnings growth could help stocks move higher. Also, geopolitical developments in Russia, Israel, and Iraq are important to monitor. With the stock market near all-time highs, any significant geopolitical shifts could trigger a sell-off. As always, we will continue to be vigilant. Take care.